our second presentation, let me introduce to you Charlie. Charlie is, he holds a PhD, is a co-founder at Tornich, Los Gatos, California, at KL Felicitas Foundation, and at Social Impact International. He is a full member of the Club of Rome, chairman of the board of Impact Assets, and a board member of the Schwab Foundation. So Charlie will give us a presentation with the title, Why We Need ESG, Impact and Deep Impact, Improving the Old Systems While We Co-Create a New One. That's an interesting title, and thank you very much, Charlie, for accepting to give that presentation here today. We are very, very indebted to you, and are very happy to share your thoughts, that you share your thoughts with us. So stage is yours. Thank you, Charlie, and please start.
Well, thank you so much, Professor Marco, for the kind introduction. And thank you, Stephen, for a tour de force about your perspectives on international sustainable finance. And I was really intrigued by learning about the sustainable finance centers. And of course, I'm aware of the issues around standardization, data, impact management challenges, regulations, talent, accredited courses, impact washing, and many more topics that you shared with us. And I'm going to key off of that and then maybe even share more opportunities for us to participate in the change, either by improving the existing system and or by creating the new one. So thank you very much for all the people who are listening in. I'm really excited to be here and then sharing the Q&A session with Stephen and all of you. Allow me to briefly just tell you who I am. So Marco mentioned that I'm a technologist. So I have a PhD in computer science from the university in Vienna and immigrated to Silicon Valley in 1986. And I was privileged to have a very successful career there with 3 successful startups. The first one being Next, which is the company that Steve Jobs created after he was fired from Apple. And I was in charge of developing the operating system, which is now Apple's main operating system. So a very successful product that I was able to develop in the early mid 90s. And then I switched over to artificial intelligence. So I know a lot about that. And that's a huge topic in conjunction with regenerative finance or just distributed finance, right? And then my financial success came mostly from being the CTO, the Chief Technology Officer at a company called Ariba, a business-to-business e-commerce company that we took public in 1999 that was purchased by SAP in 2012 for about $5 billion. And that one is still the biggest B2B transaction e-commerce system on the planet, transacting $4.3 trillion in the year 2020. When some of the SAP executives shared at the 25th anniversary of founding Ariba that number with me. Now, taking Ariba public and selling part of my shares before the crash of 2001 created a fair amount of wealth for me and my family. And so we had to wrestle with the question of the meaning of wealth. Why is it coming our way? What are we supposed to do with that? And at that point in time, either marriages break apart if you're not on the same page, right? Or actually you double down and then do things together. And that's what happened to my wife, Lisa, and I. And so we said the answer to the question of the meaning of wealth to us is that we ought to make a meaningful contribution to the humanity and the planet using our values and not forgetting about our values just because we have investments to do. So that's a little bit about who I am and why I'm doing what I'm doing. And I want to talk about 3 topics with you in the next 20 minutes. First, a little bit, what is the difference between ESG impact and deep impact, and why do we need all of them, at least right now? And then I will share with you my opinion that humanity and impact investing is at the crossroads right now, and that the first road continues on the path of business as usual and will predictably lead to economic and societal collapse. And the second road is the one, of course, that I'm voting for, is the one about deep impact that actively prepares for major systemic changes while making sure that the old system does not uncontrollably crash. And so I will then, the third topic will be, I will share very concrete efforts that I and many others are involved in to actually co-create the second road. And that will then conclude my remarks, and then we go into Q&A. So we are at the beginning of an unprecedented global transformation where humanity has precious little time, I believe, to figure out how to sustainably live on a planet with finitely resourced resources. And fundamental design flaws of our economic and financial system, like the assumption of unlimited exponential growth on a finitely resourced planet, have been contributing massively to disruptions, as evidenced by COVID-19 and the war in Ukraine. Now, in times of radical change, and we are in times of radical change, we need to continue to support and enhance the existing system while allowing the new system to emerge. A great example of this is the dynamics between ESG, environmental social governance, which is enhancing the existing system, and the emergence of the deep impact economy, which I will talk to you about a lot more. And so ESG is going mainstream. Everybody's jumping on that train. I don't need to remind you of the numbers. We all know them. And I want to make sure that you understand my opinion that ESG is not a bad thing. It's actually a good thing. It's better than non-ESG. But it has nothing to do with systemic change. And it has nothing to do with getting the real wicked problems of our times solved in time in order to avoid social collapse and environmental collapse. And that's social injustice, social inequality, ecosystem breakdowns, and runaway climate change, right? So basically, it's a way of telling you how to manage your company. Take, for instance, a weapons manufacturer, right? There's many out there, and you can make a ton of money right now to invest in weapons. And of course, most weapons manufacturers get an ESG rating. And if they have a really good ESG rating, that means that they might be much better on the environmental side, maybe even going towards green steel to produce their weapons. And they have a good governance structure, maybe even some women on their boards, and treat their employees right. And so chances are that if investing in weapons is not counter to your values and you want to invest in weapons, if you invest in somebody with a great ESG score, that you will get a much better financial return. But you see the problem in this. I chose, of course, a sector of the industry that I would not be able to invest in because of my values, right? And so if you invest in an ESG fund and don't overlay that with a negative screen of weapons, then for sure they're going to draw in oil and gas, the best oil and gas, ESG ratings possible, and the weapons manufacturers possible. So you see that it's not enough for impact investors like me to just go ESG. All financial products, and Stephen mentioned that, all financial product providers, I think, are moving into ESG because they can make more money with it. It's non-transparent right now. It's just being regulated and should be regulated more, as Stephen, eloquently made the case. And hopefully we could move ESG to ESG plus, that then is standardized, that goes a little bit deeper, and that plays a role in a 100% impact portfolio. So if you have a 100% impact portfolio like I do and many others have, and you need liquidity, and you need maybe to limit your financial return expectations to a certain band, then public equities play a role in a 100% impact portfolio. And like I said, ESG plus might be on the very low end of impact in order to get you to the liquidity and everything else that's associated with public equities. So regulators also, as Stephen pointed out, will play a big role to demand that transparency and to make sure it's comparable, which it is not right now. And so I'm hopeful that over time, with improving the existing system, that we can move ESG to ESG plus, and then it would be much more palatable to people like myself to invest in ESG plus funds that actually vote proxies and are active shareholders, as was pointed out before as well. I want to conclude my remarks about ESG just stating, I think, the obvious, that even if all the money in the world, whatever $120 trillion would move into ESG, the inequality would increase, not decrease. Social injustice would increase, not decrease. And climate change would not be mitigated in time below 2.7 degrees, maybe even 3.5 degrees, as the experts have been telling us. Why is that the case? Well, because if we don't change the financial system itself such that all the stakeholders benefit from this big transition, not only the shareholders, then the social injustice and inequality will explode dramatically like it has in the last 2 years, where the top billionaires actually increased their assets by 50% versus the bottom of the population moved into poverty. And that would be even more the case if everybody jumps on the renewable energy without fixing that issue. So to bring that home to you of what I did in this context, well, we started our impact journey 20 years ago. 20 years ago, we are like the dinosaurs of impact, right? And we moved, from supporting social entrepreneurs to saying, well, a lot of the social entrepreneurs that we support are just treating the symptoms of what we want to actually treat. And so we moved to supporting social entrepreneurs who actually work on the root causes of the system of the system breakdowns that we were interested in. And then we did that for a number of years. And what we noticed is we actually know how to move from what we call impact, which is actually thematic in nature, where you not only avoid things that are bad and then put a screening on top of a sector that is good or bad. No, it doesn't really matter, but you actually invest in the themes that are positive. That's impact investing, right? And it's different from ESG, as I just pointed out, because you make a positive contribution to themes that are interesting to you. Deep impact is going one step further and is challenging the root causes as opposed to the symptoms only, and then does it with a level of consciousness and awareness that's non-anthropocentric. Let me explain that to you a little bit. We know what to do in order to get to a sustainable planet. We know about the principles of regeneration. We know about the principles of circularity, of resiliency, of regionality. And yet, for whatever reason, we don't have the courage as humanity to say that we need to change the system now in order not just to survive, but to thrive for 10 billion people, right? And so the illusion of our brains that we're somehow special and outside of nature and outside of the ecology prompted me to copy the terminology of deep ecology. And Arne Næss coined that in Norway in 1972. It meant a non-anthropocentric view of ecology. And what I mean by deep impact investing is a non-anthropocentric view of investing, right? It's not coming out of your brain only, because if you just go with your brain, it doesn't go deep enough. It doesn't come out of your heart only, because you will lose predictably all your money and you cannot invest anymore. But it comes from your soul, from a bigger thing that's not your ego. And that is what deep impact investing is. And we do need that we need to invent that system in order to survive and thrive. So we are at the crossroads, I believe, and the first road takes us down the path of business as usual. And this road cements the existing power structures in place and does not create space for the deep impact economy to emerge, and will predictably lead to environmental and social collapse. The second road actively prepares for these major systemic changes while making sure that the old system doesn't collapse. It allows for the emergence of a regenerative financial and economic system serving humanity and the planet as opposed to just itself. And this road is much more uncertain, however, and unknown, yet filled with infinite possibilities. So let me talk about this road a little bit more. And, when I think about and bring the consciousness back in, because when I think about what happened to humanity in the last 5 years, the major two disruptions of the pandemic and the war, then, the good news is that both events have triggered, in my opinion, an elevated consciousness and awareness. We have different discussions today than we had before COVID-19 started and that before the war in Ukraine was started. So, but I want to ask two challenging questions to us today. One is, why does it take these major disruptions where millions of people suffer in order to change the systems as opposed to just treating the symptoms as we do today? Maybe the more challenging question is, will it take an even bigger disruption in order to wake up humanity to demand the implementation of the deep impact economy according to the principles that we understand. Now, my answer to that is I actually don't know, right? I hope not, because that would be a very depressing type of conclusion. And I think that both the top-down efforts that Stephen mentioned and the bottom-up efforts that I will mention give me hope that we might be able to accelerate the emergence of the new economy and don't have to wait for a major collapse in order for the survivors to create it. And time is running out for that, and it doesn't look that great right now. And if we don't really do it fast, then I think time has run out. But I'm also optimistic about the young generation, for instance. So the 15 to 25-year-olds, particularly, and I reach out to them because they don't have a voice right now in what they do. I recently was asked to do an intergenerational panel, in Oslo at the Catapult Fest. And I invited the leader of the Extinction Rebellion youth in Norway, young guy, and they are doing civil disobedience because they are not heard about their concerns about the climate, right? I think if I were young, I might do the same thing, actually, right? Because the first level of change makers, be that the first generation of feminists or the first generation of environmentalists, they're not heard unless they really do some stunts and really do something that puts the effort, that shines the light on what's going on and that we need to change something. And so it was a very, very interesting opportunity for me to contribute to that discussion intergenerationally and between sectors in Norway that either believe or don't believe in civil disobedience, right? But we certainly need to tie in the next generation in co-creating this new system for us and not excluding them. So that brings me pretty much to the third item in my remarks, and that's what are some of the emerging efforts that actually move us along the second road? It's not something out there, it's happening today. And that's really, for those of you who are more entrepreneurial, you can choose to participate in that while you choose to enhance the existing system. Nothing wrong with that. So, so impact management, is a huge topic. And so we could go on for a whole seminar about impact management. It's a very active way of engaging with the impact community and beyond, and we have made a lot of progress, so notwithstanding the lack of standards, as Stephen pointed out, but there is emerging standards happening. And the Impact Management Project and IRIS and IRIS Plus and SASB and 4 or 5 of these standards will actually be enhanced to include impact metrics. And these impact metrics then can be used by researchers in order to help us develop the postmodern portfolio theory, which we need to, because the existing way that the financial system is wrong. It's based on a theory that doesn't serve us in the context of systemic change and the major disruptions that we see happening right now. So I'm actively working with many others on including system change parameters and methodologies and principles into impact management, right? So that we say an impact investment actually is a systemic impact investment if it satisfies certain principles that have to do with regenerative finance or the donut economy or Otto Scharmer's OS 4.0. And there's lots of things happening there in order to move us along and say, okay, which part of your portfolio actually is participating in changing the system, and which parts of your portfolio are maintaining the systems but improving it, and which parts of your portfolio are actually doing impact investments, right? And our portfolios have examples of all three. And to Marco, to your point, even if we had $1 trillion right now to go into deep impact, we would not have the deal flow to actually invest in that, because it's running into these systemic constraints all the time that we need to change in order to have an opportunity to invest in them. But there are ways to invest in that. Another one is, invest in regionality and resiliency. And so I'm glad that Liechtenstein is a small country on that level, because it's a unique opportunity for a small country to make a huge difference. I'm from Innsbruck, Tyrol, right next to you, right? And I'm back here right now for in order to help create the impact economy in Tyrol. And so I've started co-founding the Impact Hub Tyrol, where we do very innovative projects with respect to incubators and accelerators for social entrepreneurs and impact entrepreneurs, and then leadership programs that take conscious leadership into account in collaboration with global networks of impact and global networks of other things that I'm involved in. And also, I don't think Liechtenstein has an ethical or an impact bank, but I'm involved in creating an impact bank here in Austria. We don't have the banking license yet, and if we don't get it, we might go over to Liechtenstein to be able to serve our clients in Austria from Liechtenstein. But in any case, every nation deserves an impact bank. GLS Bank is in Germany, and you have in Switzerland, of course, and Triodos Bank and Crédit Coopératif. And so it's an important way of enhancing the existing system while we create the new banks, which are actually fully digital in place and fully impactful as an alternative to existing banking systems. So we need to do both because the other one will take a little bit longer. We talked a little bit about research and that we need to develop in data sets. And Stephen mentioned that we need open source data sets of impact, just like we have financial data sets, and it's not, you cannot make a lot of money on just data sets. You need to make money on deploying AI in order to retrieve insights from the data sets that then will allow you to make a business. And so, so that's really, we're working with it in the context of Tonic, which is the biggest global network of private impact investors that I co-founded 12 years ago now. And we have about 20 billion under management, not a whole lot, but the most innovative, the most creative capital in the world, right? And I think Stephen is right that we need to bring that capital to the table, in order to enable the UN to make progress on the sustainable development goals, because if you just do it top down, you will predictably fail. And so I'm last point I want to make here is technology, and Stephen keyed it up a little bit too. I think that that DeFi, distributed finance, is already that train has taken off, right? And which is good because it will allow more streamlined financing. But again, it doesn't change the system. It's streamlining the existing system, which is good with respect to servicing your clients, but it's not good with respect to saving the planet. And so I'm working on technologies like tokenization of impact. So crypto, I would not be able to invest in crypto because it's pure speculation, and my values prevent me from investing in pure speculation. Plus, it uses so much energy that we would never be able to invest in that, right? But the next generation of blockchain is where I'm investing in, and AI, and that's based on a different protocols called staking. And the fact of the matter is that I have to go to Switzerland to do this right now because the regulatory environments in the EU are just not really understanding what tokenization is, and they don't allow me, to invest in that. Similar in the US right now, and in Singapore and in Switzerland, actually, we can't do that because the regulators have figured out how to allow us to create an impact utility token that then becomes an investment token and not have to change regulatory frameworks and move into impact staking. So I want to change the staking industry into impact staking, just like we did the investment world into impact world. So tokenization of impact has the potential of changing three systemic issues of the financial system as it is designed right now. Number one, not in priority order, it actually allows everybody to participate, because if you have a token that you can change into fiat currency and it's exchanged in a public exchange, then you can, anybody with a few euros can participate. Number two, you have liquidity, because again, if you have interchange rates with the fiat currencies, then you can just liquidate anytime, any point in time. You're not tied to LP, GP structures, which only the rich can afford, right? And makes them richer. And three, I would say that's the most important one, is move from shareholder value to stakeholder engagement. If you do the tokenization correctly, then actually you can incentivize all the participants in that token with positive incentives. And that, I think, is a very important move forward and changes part of the financial industry. I think it's the follow-on model of social impact bonds, which never scaled. And I invested in the first social impact bond in 10 years ago. And in Peterborough, where the financial return was explicitly tied to the proven impact, negative return, positive return. A lot more to discuss on that for those of you who are technically inclined. But I just was in Davos, a couple of weeks ago, and the Swiss government understands that opportunity, because the foreign minister and the minister of finance hosted an event where they said, well, Switzerland is going to be, the nation that wants to welcome that new type of financial structures and not prohibit it. And that's why we do it there. And I hope that the EU will get its act together to provide a regulatory environment where modern investments can be done in order to make an impact on society and the planet. So with this, I'm coming to my conclusion here, and so I want to remind us, sort of with my premise, that one is not better than the other. We need ESG, we need impact, and we need deep impact. And only a few people are qualified, to work on deep impact, because it's very entrepreneurial, very, very risky, and yet it has to be done. But it has to be given the space in the debates around this, and not saying one is better than the other, or one doesn't work, or one doesn't this or that. We need to get out of our own echo chambers and really work on solutions that include all three aspects, just like Stephen ended with needing public capital and private capital in order to make a dent into SDGs. And I want to make it very very personal for you in my last remarks, because I almost died of cancer 3 years ago, a very, very, very difficult type of cancer, and I came out of it after 1 year. And it provided me a lot of time to reflect on my own purpose in life and my own contribution to the few years or decades that I have left. And that, together with having a grandson that's 11 months old and a mother that's 94 years old, which shows me the unbelievable beauty of human life, in the context of birth and death and our responsibility in that. I want to invite you to reflect on your own meaning and your own contribution, with respect to the changes that you want to see, and not delegate that to somebody else, and then reach out to others that you disagree with and engage in conversations that actually make a difference. Thank you for that. I very much look forward to an engaging conversation, and happy to dive into any of the topics that I mentioned deeper. Thank you.
Thank you, Charlie, for your interesting speech. And I would go on to the next step in our today's seminar. We start with the panel discussion by Charlie, Stephen, Thomas Trout, Simon Trebelhorn, and myself. And I would offer our two speakers of today the privilege to start with any comments about what they heard from the other speaker. Would that be possible? Charlie, do you have any comments to Stephen?
Yes, absolutely. So I really enjoyed Stephen's comments, and it so resonated. Like I said, we need to have bottom up and top down, and enhance the existing system. And Stephen, since we're talking about impact, I wonder how you define success for the SFCs. How do you measure impact? When you say this is done, or it might not be done at all in 2-3 years, or in the context of the SDGs, and how do you maybe avoid impact washing, which is correlated to my first question?
Yes, thank you, Charlie. Look, it's a really important question, but it's also a very difficult question for a lot of the reasons that I went through earlier on about data and things like that. But I know when we were doing the Irish roadmap last year, they were trying to define what does success look like by 2025, and you have to be very realistic about it. And, Ireland has 4 trillion in funds serviced out of here. Are you saying that all those 4 trillion will be SDG aligned? The answer is no, that's not going to happen. But they were kind of looking at, we did a piece of work in PwC, and they were saying at a minimum 25% of those funds should be aligned with the Paris Agreement. At a minimum 50% of all banking activities should be aligned with the SDGs. So it kind of went into that degree, Charlie, of detail, but it's still very high level. And I suppose what we do, Charlie and colleagues, with the assessment program is the assessment program itself isn't just developed in isolation. And you saw, like a little clock, there was hands, and you could see that Liechtenstein was at 2.6, whereas the majority of members were at 2.2. What does that mean is that we've developed with PwC Paris, who are an excellent bunch of guys, a methodology to say, well, how aligned is a financial center with the Paris Agreement? And level 5 is when a financial center is fully aligned with the Paris Agreement. Nobody's going to get there the next 3, 4, 5 years. We hope that there'll be a lot of financial centers there by 2030, right? But what you're seeing now, Charlie and colleagues, is we're seeing a lot of members in and around 2, 2.5, 2.6 on that methodology, with 0 being we're not doing anything. So what you're seeing, Charlie and colleagues, is in between 2 and 3, financial centers are getting very strategic. And that's what actually Liechtenstein is screaming from their document. Liechtenstein, and one of the elements is at level 3, which is very, very strategic. So that's what you're kind of seeing, Charlie. It's the first model of its kind globally, and we're obviously we keep refining it because it's brand new or newish. But we have it on a simple methodology, 0 to 5, and that's where we have in terms of the alignment. Liechtenstein is doing very well there, but now we have financial centers saying, okay, that's great, but if I want to reach by 2025, where am I in terms of alignment, and what at a real level does impact look like? As I said, banking 50%, bonds are Y%. So we keep trying to refine that, Charlie. But what I am seeing, Charlie, and I was inspired by your remarks, is the amount of big firms coming to us now and saying, hey, we really need to figure this out. We really need to sit down with you guys and say, what does SDG alignment actually mean? And so what we're now seeing, Charlie, is we're getting into the plumbing. We're like the tradesmen going in, and we're getting into the plumbing of these firms and saying, how do you measure? What does that look like? So I personally feel, Charlie, in the next few years, we're going to see consolidation around standards and the different metrics and methodologies. And we're going to see the bigger firms on the back of their big balance sheets really put a lot of time into ensuring they're aligned. And I see that being the next wave of this agenda, Charlie, over the next 2 years, based on a pretty robust policy and regulatory environment. Hence the reason why Europe actually has a leadership role right now, and will either keep it or lose it.
And I think the feedback loops and adjustments is brilliant, because if we don't do it that way and keep it static, then we would not be able to adjust to the realities that are evolving, in real time.
Yep, and it is real time. Charlie, I don't know, 3 years ago, if I opened the Financial Times, I wouldn't see anything in it about sustainability or ESG or impact investing. Now, half the articles are referencing this has happened, either negative or positive, right?
Right, and 3 years ago, we were able, totally agreed. And 3 years ago, systemic change became a topic. That's not where you're not thrown out anymore by the powers to be. I remember having a workshop in Munich with a big bank and a not-for-profit talking about financial system change, and we all agreed that it has to change. But the big bank thought it was part of the solution, and I thought it was part of the problem. So we had a really good discussion why that is, right? Yeah.
All right. Okay. Thank you. Stephen, do you have a question regarding the presentation of Charlie, or should we go on with the other panelists?
No, I just have an observation. I found it inspiring, Charlie. It's an honor to be on a panel with you. And like Charlie, I had the same, we had our youngest child born a few years ago, and, our eldest was Sport Billy running around the place, and you have a young child and you're suddenly told a few hours after he's born, he won't walk, he won't talk, and you're going to need to widen the door frames. When I asked why, well, for his wheelchair. And these sort of things kind of take you, as Charlie said, take stock of where you are and the life you may have with your child. And, fortunately for us, our child overcame his challenges. He's a robust little fella, likes beating me up every chance he gets. I can't walk past him anymore without getting a dig, but he's only a young lad. But it is, I think, as Charlie said, you kind of sit there and go, well, where do you want to be and what contribution do you have to society? So I found Charlie's, only an observation, Marco, I found it inspiring, and I'm delighted to be on a panel with him.
All right. Okay. Well, then I would be, I think Thomas or Simon, do you have any question at the moment? If not, I would jump in. So would you like to? No?
Go
Yes?
ahead, Marco.
Go ahead. Okay, good. Yeah, I think the two presentations or speeches have been very interesting and on different topics. And that was very interesting for the audience today. So another time, thank you very much, Stephen and Charlie. Regarding the first presentation, Stephen, you also offered us some specific information on Liechtenstein. Oh, no, first of all, how many sustainable financial centers do you count at the moment? Is that number, I never found that number somewhere.
Well, it's because we don't count sustainable financial centers. We count financial centers, of which you said there's around 100 globally. We're about to welcome our 40th members. So we have got 40, as of next week, we'll have 40 members, and they represent around 80% of the global markets and equity and elsewise. So you've got the biggest kind of cohort. And that's what we're trying to do. Is we're not saying that we want them to become sustainable finance centers. We want them as financial centers to be fully integrated in the ESG agenda and mobilizing more capital to support the transition. So that's the way we look at it, Marco.
Okay, good. Well, to my original question, Liechtenstein, how would you say is Liechtenstein positioned in that research which you presented today? If we only look at the very small states like, well, Luxembourg is 10 times Liechtenstein, but so if you look at small states or smallest states, what would you say, how is Liechtenstein positioned? Is it then also close to the median, or is it better, or is it worse? So the question is, our competitors in terms of smallest countries, how are we compared to them?
Okay, so reminding ourselves that I work for the UN, so I'm not about to cause a diplomatic incident. I think the key thing is to take a step back and say it doesn't really matter about size per se of the country. It's in terms of assets under management. It's in terms of activities from a financial services ecosystem that the center is actually doing. And Liechtenstein very much boxes above its weight on that. So that's the first point. The second point is, you know, if you look within what we do in the assessment program, it's not meant to be, Marco, an index to say where are different financial centers playing. So all these reports, and Simon was good enough to allow me today to publicly speak about the findings from a Liechtenstein perspective, but we give all these reports to our members individually and in private, because we don't want to create that type of false dichotomy, which is an index which we, as I said, don't want to create. But in terms of where Liechtenstein is positioned very well within the overall FC4S. I don't mean small or big countries. And you have to ask why. And it goes back to the institutional foundations and the enabling environment. You know, there's a plan in place. It's a robust plan. It's been refined over previous years. There's a willingness to learn from different jurisdictions what is happening, right? And we saw that, you know, in terms of the talent piece, Liechtenstein among all our members, and that's big and small, is in the top 25% of financial centers with a focus on this. So I suppose the key thing when you look at slides 14 and 15, Marco, is Liechtenstein, as I said, is punching above its weight. Yes, there are challenges where if Liechtenstein was to do A, B, or C, it could potentially do better. But I think the key thing also to remember is that what we're doing here and what we're trying to do is still a relatively new area, right? And as I said, some of the challenges that we have, every financial center around the world is facing the same challenges that Liechtenstein or Luxembourg or Hong Kong or London may face. Yeah. So it's not who's doing better or who's doing worse. It's actually who is putting in place a process, in this case, a roadmap or a specific strategy, which the ecosystem, both public and private at the financial center level, has bought into, who are putting resources into and are actually delivering against and are tracking the progress. And within that, Liechtenstein is in the top tier of our members and has always been the case. And that's driven by Simon and I'm not trying to embarrass Simon, but that's driven by Simon and the grouping that he has around him on sustainable finance.
Okay. Thank you. Then just one question to Charlie. Charlie, I did not really get that difference between impact and deep impact. I know now it's heart and soul, and I know the difference between both, but it's difficult for me to understand that. So could you perhaps explain that another time? And then my question is, what financial instrument do you use if you invest into impact or deep impact? Do you invest in exchange traded stocks, or do you invest in private equity or private debt, or what is the financial instrument?
Yeah, of course. Thanks, Marco. So on the first one, right, let's take the financial system itself, right? And I made the case that I believe that the financial system has to be changed systemically in order for it to get rid of the design mistakes that enable right now only the rich to get richer and inequality to increase. It also is responsible for the fact that burning fossil fuels is much more profitable than leaving them in the ground. That's how the system is designed. It's designed such that biodiversity loss is encouraged, and it's much more profitable to cut down habitat for biodiversity than and transforming it into monocultures, right? Than leaving it alone or rewarding indigenous communities to actually for the maintenance of biodiversity. And so you see that these questions go deeper into the system than just saying, oh, let's make green bonds or let's make an impact bank, because they challenge the design constraints of what are the externalities on the social side or the environmental side that are not included in the market right now, that need to be included in the market in order for the market to actually deal with that. And we know that the invisible hand of the market has not worked for inequality and social injustice. It has increased dramatically. And so the difference between impact and deep impact is that deep impact actually goes and challenges these assumptions, right? Where maybe financial return is explicitly tied to proven positive impact. Now that if all the investments in the world would work, that you make more money if you have more proven positive impact, and the corollary that you would lose your money if you actually have a negative impact. If all the investments would be done that way, then we would have changed the system, right? And so that's the difference. There's the decentralized finance, is enhancing the existing system in order to make finance more efficient, in order to increase the profitability of the existing players, but it doesn't change the equitability in who participates in the upside and who takes the downside, right? So those are venture capital and private equity term sheets. If you look at that, they all are preferentially treating them vis-a-vis the entrepreneur that they invest in. That's not in right relationship. So I give you just a few examples where you see the principles of in right relationship, which is a living principles of deeper systems change. Is driving that discussion. And as I pointed out before, there's not that many deep impact investments out there because you edge into the system all the time. But I've shared with you a few, including the tokenization of impact, maybe even NFTing impact, and trying to figure out how to create a market for impact as opposed to just for finances. So we and many others are working on that, which fundamentally will change the system if the system would allow us to grow to a certain size, which right now it does not. And if it does not, then we will not be able to create the new system, which would be a shame, because then the existing system will collapse uncontrollably. So the way that we have structured our finances is, in the high double-digit million portfolios of private investors, you usually have 2 or 3 or 4 different portfolios. In the US, you have a philanthropic portfolio, right? That has as its main goal to have a big impact and on the philanthropy side. Usually, if you either have a business that you run or you invest in order to get cash for your living expenses, that's a separate portfolio. And a third one might be your real estate, and the fourth one might be an intergenerational trust or family investment vehicle with your kids or whomever it is. Now, we structure the portfolio of our our foundation, and you can read up on that very, very transparently. That's the most risk that we take on the impact side, and that's where we position, our investments in changing the system. And if we lose some money in that, which we do, then that's fine, because we don't measure our success in just the financial return, but in changing the system. And so when we invested in the first social impact bond, which was dealing with the theme with the impact theme of reducing recidivism of people who are incarcerated and then are released from prison, and 40% of them are back in prison within 1 year. And so the bond was structured in such a way that if we could lower that to 20%, half the recidivism rate, then we would get up to 13% in financial return. If we don't go above a hurdle rate of 7%, then we would lose our money. And we actually did 11% of decrease of recidivism rates, and we got 3% in return with respect to financial returns. We did that investment not in order to reduce recidivism, but in order to create a new financial instrument that if it went to scale, that would actually, we could securitize it, we could put an equity on top of that, and then that equity would go up and down with proven impact, negative or positive. So that's our systemic change thinking with respect to social impact bonds. Now, they didn't work, and we only have 140 because, number one, they're too complicated. Number two, the people who pay for it are governments, and they are too fickle, and most impact takes longer than 4 years, the cycle of voting, right? And so we are fixing that with tokenization. So we learned from that and now going in that direction. So, and we do that out of our foundation and showcase that, and then we learn from that, and then if it works, then we do that from our other portfolios. You can read up about our asset allocation and the impact that we have had. We published an impact report that shows you all the way from SDGs to impact themes to IRIS metrics how our portfolio did. And because we wanted to have up until 4 years ago what they call market rate returns across a weighted benchmark of asset class benchmarks that the industry agrees upon, that we showed that was possible while having 50% of our investments in deep impact and 30% in shallow impact and 20% in negative screening. And so if you want, I can share the report to you for the members who are listening to this podcast or to this webcast if they want to read up on that. We have a lot of data on that, how we do that in our reports. And Tonic as a platform has a bunch of reports as well of asset allocation and where to go deep and not. Lots more to discuss. I just want to summarize a little bit. Yeah.
Thank you very much. In the meantime, we have 2 questions in the F&A, but we first finish our round with the panelists. So I would now hand over to Simon. Simon?
Yes, please. Thank you so much. I would like to maybe connect the dots. I think we have heard from Stephen mainly, there is a lack of talent all over Europe. And Charlie rightly pointed out that we need a system change. He strongly advocated for deep impact, for regenerative finance, and connecting the 2 dots or to 2 statements, so to say. And maybe the question is for Charlie. What are the skills we need really to have this system change happen in the end? Because in my view, we are focusing currently mainly on what are the right processes, what do we have to do to implement all the regulations. But in the end, I think we need to have a mindset shift, and that you pointed out, that you have pointed out as well. So, what are the right skill set we need to have to make this system change happen? That's my question for you. Maybe for you, Charlie, but maybe for Stephen as well.
Yeah. Well, I'll start, and then Stephen, please, chime in. And Simon, right? You pointed out, the most difficult part of the explanation of deep impact for people who have not had the chance to think holistically, right? Because in the last 300 years, we have trained our brains, including mine has a PhD in computer science, and my brain constantly, segments because I'm trained in that. Yet I'm also trained as a system thinker, right? And therefore, I think the biggest change would have to happen in our own thinking patterns to change from reductionist thinking to holistic thinking. Take the SDGs. If you just mainly focus on one SDG, you might actually invalidate some other SDGs if you're not careful about holistically thinking about the negative effects of optimizing only for one, right? And so I did a presentation to UNIDO 3 years ago, and almost like not almost, I suggested actually, creating an SDG 0 that is the awareness and the consciousness that would tie it all together. Because without that tying it together holistically, I think that we will predictably fail, right? And the other skill set is also surprising to most people, but that goes along with that. And again, I'm a technologist. I had to work on that really hard, and as a successful executive who made a ton of money in Silicon Valley, it was extremely hard for me to do that. But to not confuse, success on that level with what that means holistically for the universe and for nature and for our planet. So just optimizing again for monetary success at the expense of everything else, is not the right approach. And our current success metrics in society teach us, and we celebrate the Elon Musks and everybody else, right, who makes a ton of money, but who confuse, developing our travel to Mars as a contribution while our planet is burning. And I think that the urgency, to really do things differently, I think can only be done with a wake-up call. It's a step function in awareness and consciousness, that, as I pointed out. And I like the way that you framed it, Simon. But it's something that, particularly for the financial profession, I could not have had that discussion 3-4 years ago when I talked to hedge fund managers. I talk about hedging, right? Because then I get listened to. You have to talk to the people in the language that they are able to digest. And I position impact investing and deep impact investing as a hedge against the downturn. They understand that. And if you look at our portfolio, 2008, 2009. Indeed, our portfolio didn't go down as much as everybody else in that particular crash, systemic crash, because of the uncorrelated impact investments that we had. But we are not at scale, so I couldn't prove it statistically relevant. And so to make the case, to the whole industry, but the hedge fund managers understood what I was talking about, because they understand if an asset is not correlated to subprime or not. And so in order to, so we have to speak the language of the existing system, in their terminology with their benchmarks. But I'm just dismayed that in my real asset portfolio, I have to make the case that my financial performance is better than an extractive portfolio that I would never invest in. Fortunately, it is better, but it's not the right comparison.
Okay, good. Could I pass to Thomas now, or?
Yeah, sure.
Okay, perfect. So, Thomas.
Thanks a lot, Charlie and Stephen. Very interesting. My question would be, how shall we, as a society and as politicians and as market participants, deal with some of the conflicts of the objectives we are pursuing? For example, if we make fossil fuels more expensive, which I think is very important to do, obviously this can have so-called unjust consequences, because maybe poor income households are hit stronger than the rich. And that, it seems to me, is very much also an obstacle for politicians to tackle the environmental and especially the climate challenge more fiercely. And in fact, as we recently observed, when fossil fuel prices rise dramatically, as we have seen it now after the conflict in Ukraine, governments start to subsidize or lower taxes on fossil fuels. So I think it's something which goes directly into the other direction and is justified by social considerations. I would be very interested to hear your thoughts on this. How can we handle this as a society and as politicians?
Thank you for the question, Thomas. That's to Stephen.
To both, I think.
Okay.
I'm sure both of them.
Before you start, we are running out of time a little bit now. Please answer quite short, because we still have 3 questions here. Well, there are 2, but there have been 3. So please answer quite short, and then we have still time for questions from the audience.
Stephen, do you want to start?
I'll let you go first, Charlie.
Yeah, so I mean, short, it deserves more, but short, number one, takes the subsidies out and really out of fossil fuels. It's, why do we do this? It's not the population should actually demand that we support the new way of going renewables and not the old way. People ask me about how can society invest in peace? Well, don't invest in weapons, right? And so there's some easy ways of actually saying, well, if I care about values, let me make sure that my portfolio, my bank is not investing contrary to my values. And again, if all of us would voice our concerns about this, the bank would change. And number 3, there's no free lunch. And just like I suggested that we all need to change ourselves in my last remarks, and changing yourself is hard. And mindfulness journeys are hard, but without doing the hard work, you will not get deep. And so the same is true for societies. We cannot expect to make the transition to a sustainable world without making some sacrifices in a transparent way, where the poorest of the poor are actually taken care of to a certain extent, right? In a clever way, and not in a way right now where the existing economy that thanks the planet is getting the most subsidies of COVID, and the new industries don't. So we are making the same mistakes again, which we need to avoid.
And very quickly, if I may, look, the challenge here is also a north-south one. And so, as Charlie said, in the north, we could do a lot of what Charlie's talking about there, take subsidies out and so on and so forth. But as Thomas pointed out, the election cycle is usually 4 years, and it's actually usually less, right? Once they're in government, they're thinking about how do I get re-elected, and what policies do I not want to put in place. But that's one thing, and I think, Thomas, what we're seeing at a European level at least is all the commitments that are being made within the EU are legally binding. Right, so that's kind of one point, and then I do think the OECD countries need to get serious about supporting the emerging and developing economies. Right, we talked about 100 billion; it still hasn't been met. That was 100 billion when it first came out. Inflation is probably 200 billion now. In 2-3 years, it could be $500 billion. Right, so we still haven't met the minimum commitment we made X years ago on 100 billion. So if you're a politician, a civil service, you're in one of these emerging economies, and oil and gas is whatever price it is, and obviously inflation is rising now, you don't have the funds in place to support the transition. You don't have the funds in place. You may not even have a deep social net, a healthcare system that fully functions. So again, going back to Charlie's point, yes, get rid of the subsidies. Yes, from a retail perspective, how do you offer new products and services where capital can flow to fund these newer technologies? But then the West has to get serious about supporting the emerging developing economies in a way which is, it's like the SDGs and frameworks, I want to use that, but how much capital is actually really needed. And it's going to be the greatest return on investment that we can actually make. Because at the end of the day, if we don't support, forget about livelihoods and healthcare and all that, you're going to see such a societal upheaval in these economies. It's going to be quite dramatic, and this is the right thing to do. But I suppose the last point, going back to Thomas, is how do you do it though in a way that you see return? And I'm not saying a commercial return or an investment return, but you're able to measure that impact. And this is kind of has escaped us for the last few years.
And just to key off of that, the societal upheaval will be much worse if we continue on the path that we're on, because climate change is going to create, the weather events and all that, and the inequalities are tearing societies apart right now, and we're at the verge of creating very violent events, and that are very difficult to put back in the box. So my answer is, the path that we're on is actually more risky than what I laid out.
Okay, thank you very much. I would like to go on to the questions from the Simon. I have seen your hand. I would first go to the question in the F&A. There is one anonymous participant writing, I found the statement of Mr. Kleisner that the financial system itself has to change very interesting. I think at present, still the pure profit motive outweighs any strategy for the positive of humanity and the planet. What could you more specifically advise to accelerate this change? Should also investors and their advisors change and move away from pure financial performance? Now, who wants to say something to that? If possible, please short. Who?
I can just answer that quickly.
Yeah.
And so you're right. We need to change finance, not finance change. Finance change is the old way, and it's necessary. But in order to make the difference, we need to change finance. And of course, we need to insist on transparency of the positive and negative externalities and the measurements, and need to force our advisors to help us, to help us get that. And family offices and institutional capital is not in the lead on that. They cannot be. It's really private capital. And so my peers, about 600 investors around the world within Tonic, are moving in that direction. But if ultimately we don't change top down the institutional capital, it will be for nothing.
Thank you. Anything else from? Okay, no. Then I would go to the second, perhaps a personal remark to the first point. It's up to us investors. It's up to us. We have to make the decision. That's very easy. And if we want to invest in impact, the problem for me is, do we find impact? But anyway, if we have impact investment opportunities, then we have to do it. And we don't have to wait for the others. We could do that. I think the problem is information, perhaps. Second question, Mr. Kleisner, another time, Mr. Kleisner asked on measurement of impact. What does he think about the methods introduced by SFDR and TR or CSRD as regards to information on success of the ESG strategy in periodical reports? Are they a way forward? Charlie, that's you.
Yeah, I'm sorry, I'm not totally up to speed on SFDR and CSRD, but I'm in favor of any impact reports that are not greenwashing. And any regulatory requirements to do impact reports, I'm all in favor of, and we need to do more. We just need to create standards, as was pointed out before, and we need to create standard formats, that allow us to compare apples to apples and not apples to oranges. So, and that's a very active area of development and regulations, and it will take some time to flush out, the top 3 or 4 or 5 methodologies. I mentioned a few myself, and these might be others that are certainly helpful and need to be flushed out.
Okay.
Marco, if I could just jump in there, I think the CSRD one in particular, given that it's coming out of the European Commission and it's going to cover the entire EU, is incredibly important, right? And it just kind of underpins the evolution of the disclosure and reporting agenda from voluntary towards now mandatory. And I think as we move towards mandatory, and it goes back to capabilities within your firm, finding the right data. So it's going to ensure that investment at the firm level is actually made. So I do think it's really an important next step, but I'll say it's the next step. I think, from my perspective, reporting disclosure underpins everything that we're talking about here today. If you can't do it at a basic level, well, then your company, forget about it. Now we're moving towards mandatory. It's got teeth. And this comes back to the greenwashing thing I was saying earlier on. You have to be able to do this from a firm perspective, and somebody needs to know if you're a good bet in terms of investment.
Okay, thank you, Stephen. Now, we still have 2 questions. One is from Tobias, collaborator of the chair, and the other is from Simon. Tobias, could you give your question very fast?
Yes, I would have a question to Stephen Nolan. In the slide 16, you stated that policy and regulation is the area where Liechtenstein can do something in the future. What do you think? Should they focus more on hard or soft law?
Well, I think since this document was first developed, Liechtenstein, it's 6 months old, so other things have been happening in the Liechtenstein market, which I know Simon and colleagues have been involved in. But it doesn't matter if it's Liechtenstein or anywhere. At this point now, it's hard, right? This is what I suppose the point we're getting at today. You know, we're going through an evolution. If you look at the European Commission, it's gone from voluntary towards mandatory now, or even TCFD, whatever it may be, or whatever you're using. So that legislation has to be more hard. Because it's going to underpin, you know, methodologies, disclosure, reporting. So that's what we're seeing in other financial jurisdictions, financial centers, is that they're now moving towards harder laws. And I think I know what you mean by hard versus soft, but they are moving towards harder legislation, which is harder, which is backed up by regulation. And I think last point, Thomas, is that the regulators are ahead of the policymakers right now in this agenda. Yeah, so that's what we're seeing happening across Europe as well. So, and they're beginning to come out with harder rules, or will be in the next 18 months.
Okay, thank you very much. And then Simon.
Thank you, Marco. Well, it was not a question, just a remark or two remarks from my side. The first one relates to a question in the Q&A section,
okay.
which
Thank
was
you.
directly addressed to me. I tried to answer it in writing. The question was what we as an LBA are doing in terms of raising awareness and let's say raising towards other financial service providers. That's related to what Stephen said, that how to improve Liechtenstein and let's say to have more financial service providers on board and have a clear roadmap on sustainable finance. That's the first remark. The second one is maybe to Charlie. You mentioned that you had to go to Switzerland because there is a regulation in terms of blockchain and tokenization. Well, you don't have to go to Switzerland. You can come to Liechtenstein as well, because we have a blockchain law in place since 1st of January 2020. So happy to have you here in Liechtenstein as well, and active in Liechtenstein.
That sounds wonderful. I was not aware of this. I was like I mentioned, Singapore and Switzerland were pointed out, and so glad to hear that Liechtenstein is at the forefront. Not surprisingly.
Okay, so thank you very much. We are at the end of our event.